Good morning, students. Very good morning to all of you all. I'm sure you all would have by now practiced, revised the entire PGBP head, which, as I've been repeatedly saying, is one of the most important topics for your exams, inter, final, both, and also for your profession. So that is the relevance of this chapter in your career, that you will be getting a client for income tax return filing who would be majorly coming to you for the PGBP head computation. Right now, today we have to start the capital gain head, and at the same time, there are some theoretical topics left out from PGBP, which I'll cover first, as we had discussed in the previous class. And after covering that, we will take up the capital gain chapter, and I'll talk about capital gain at that time. But before I take up the remaining theoretical points, you have to first tell me what are your challenges, doubts, questions relating to PGBP, because now we have completed PGBP completely. And in next 15-20 minutes, the remaining theory will also get completed. Yes, very good morning, Sridhar, Anchal, Vishakha, and everybody present. So students, first tell me your queries, your doubts, so that I can first clear them and then we proceed. No queries? Okay. Now from the module, we have studied everything. I have first taken from my notes, then I've taken from module. So both things I have ensured that it is clear. Yes, Mehak.
Good morning, sir.
Very good morning, Mehak. Please tell me.
Okay. Sir, in TYK first question, sir, there is a problem, sir, when I solve. In optional regime, sir, depreciation calculation, I have problem, sir, one doubt, sir.
Tell me.
Sir, if whenever we calculate depreciation, sir, as you just given formula the WDV, we follow this method, or first calculate WDV, then separately show the working note of the additional or the normal depreciation, sir.
No, but I did not get your point. So see, there is a format. The format is opening WDV plus actual cost of asset purchase minus sale value, correct? This difference gives you the WDV, right? This is called as WDV under section 43(6).
Yes, sir.
Now, after this WDV, you have to compute the amount of depreciation. Now, since here you are in the old scheme, it will be regular plus additional both, correct?
Yes, sir.
So what is your question? I still didn't get your question.
Sir, in study materials here, Institute ICAI solved that, sir. First, calculate the WDV, then separately show the normal depreciation and additional depreciation.
If your question is whether you have to separately show the depreciation, answer is that is not a compulsion. You can show it in the same working, right? They may have showed it separately so that you don't get confused with different figures. You can show it in the same working. You can show it separately.
More doubt, sir. Sir, there is a given depreciation for new machinery, 1st December 2025. So there is, sir, additional normal depreciation, only half of depreciation is calculated, but remaining full is not calculated. Why, sir?
So, beta, what is the WDV of that block? If there is only one machinery in the block, then there will be only one depreciation. Why? Because that machinery is half. So you will take only half, na? when you will take both half and full, when you have both types of assets. If you have
Okay,
only
sir.
one asset, then there will be only one depreciation.
Yes, sir. Yes, sir. Understood, sir.
Yes.
Sir, one more doubt, sir.
Yeah.
This is last doubt, sir. Wait, sir. Sir, in question 11, sir,
Hmm.
there is a given gift or temporary wooden structure. This is where is given for this depreciation, sir? For question number 11, sir. TYK.
So what is your question? The rate of depreciation?
Yes, sir. For specifically given for the gift and this type, sir. Scientific research, sir, for this.
See, there is no separate rate of depreciation if it is gift or scientific research. See, rate is same. It depends upon whether the asset is building, plant machinery, motor car, intangible asset. So rate depends upon the nature of asset. Now, if it has been received under gift, if you remember in the previous class when we were discussing the theory part of depreciation, there were
Yes.
three special categories of computing actual cost, in which the third category was that where your asset is acquired by you in such a fashion that already some benefit of that asset is taken. Like in your case, you have already used that asset for scientific research. Now, when an asset which is already used for scientific research is brought into business for regular business, if you remember, scientific research already allows you full 100% deduction for the capital expenditure. Since you have already taken 100% deduction for the scientific research asset, hence over here, while computing depreciation, the cost of acquisition of the scientific research asset would be taken as nil. See, we have discussed this in the last point, last lecture. Similarly, if the asset was purchased for any 35 AD business, now the cost will be nil. Correct, no?
Yes, sir. Yes. Understood, sir. Thank you, sir.
Yeah. So I think you would have got in the answer, they would have shown the cost as nil. And that is why I think you have got confused for the scientific research asset, right? Okay. Now, let me take you to the remaining theoretical pointers from our module. So we have something called as tax audit. This is how regularly people recognize this. Now, audit, you'll be studying separately in a subject called as audit and assurance. In simple words, audit is checking, verifying your books of accounts, your records to ensure that whatever transactions you have entered into, those transactions are properly recorded in the books and proper accounting treatment is given. Now, on similar lines, now we have studied the entire PGBP head. We have studied that there are so many different provisions and different provisions have different conditions, restrictions. Some provisions restrict you deduction. Now, the government wants to ensure that every taxpayer has done this calculation correctly as per the provisions of law. So they appoint or they, I can say, authorize chartered accountants to do audits of these taxpayers and submit an audit report to the government. And on the basis of this audit report, the government will come to know whether the taxpayer has correctly applied all the PGBP provisions and done their calculations correctly. This audit, which is made compulsory, which is made mandatory by the Income Tax Act, is called as tax audit or income tax audit in common parlance. Now, in technical language, we call it as Section 44 AB audit. Why? Because this audit is given under Section 44 AB. Now, this audit, I repeat, is for the purpose of ensuring that taxpayers have computed their PGBP income correctly. So this audit is mandated only for business assessees, not for other head assessees. So that is why you did not study this in the previous heads. Neither you are going to study it in the later coming heads. Now, this audit is applicable one to businesses, two to only those businesses whose turnover is very high. So if your turnover is low, then the government does not want you to get audit for two reasons. One, if your turnover is low, obviously there would be less chances of any type of tax evasion. So the risk of tax evasion is also low. Second reason is that if your turnover is low, it may not be feasible for you, firstly, to maintain detail books, and secondly, to get them audited by hiring a professional. So, for both these reasons, the government has felt it not to make it mandatory for small businesses. Now, for which category of businesses the tax audit is mandatory, that is what you need to remember. Later on, when you go to your articleship, you will practically do this in your office. Now, what you will do in tax audit, simply whatever PGBP provisions we have studied till now, you will check whether all the provisions have been correctly applied by the taxpayer while computing their income and tax. Simple. So your role as a tax auditor would be to check compliance with the income tax provisions. Now, to which businesses tax audit will be made compulsory. So first basic rule is where a person is carrying on any business and the turnover or gross receipts of such business exceeds 1 crore. In that case, the person will be required to get the books compulsorily audited and submit the audit report in the prescribed forms. Second, now considering the growing scale of business, the government wants to promote that you do your majority of the business through banking channels. If you do that, then instead of 1 crore, the limit has been raised to 10 crores. It means you will be required to get your books audited only if your turnover exceeds 10 crore. But when this higher limit should not exceed 5%, in other words, 95% or more of your business receipts, 95% or more should be through banking channel. If you ensure both these things, that on the receipt side and on the payment side, whatever receipt payments you have, more than 95% is in banking route, then instead of the 1 crore requirement, you will be required to get your books audited only when you cross 10 crores. So obviously this is a big relief. Now this particular tax audit rule is made applicable to businesses. Now within businesses, we have some special types of businesses for which we are going to study after this. The next theory point is after this. That is dealing with some specific type of businesses. What are those specific type of businesses that you'll study under section 44AE, section 44AD? Now, when you are covered in any of these specific type of businesses, then the rule is that whenever you are covered in these specific type of businesses, which is covered in 44A, 44AD, in that particular case, we are going to study in these sections a simplified approach of computing your PGBP income. What is that simplified approach? I'll give you a small hint here. So if you are in the business of transportation, that is your business is transporting goods. In that case, the law has given a simplified mechanism of taking your PGBP income at the rate of 7,500 per month per truck. So the simplified approach given is that instead of going for detailed calculation, you can take a simplified income like this. So there are different methods given. Now there are sections where they have given you an approach to calculate your PGBP income in a simple manner, not in the manner which we have studied till now, the complicated manner. Now the requirement is, if you are covered in any of these sections, as you can see here on the screen, 44AD, 44A, then you cannot show your PGBP income below this amount. So whatever this simplified approach is giving you as the PGBP income, you should always declare or show your PGBP income more than the estimated or simplified amounts given in these sections. If you are showing a lower amount than this particular limits, the tax audit becomes compulsory. So if you are covered in any of these simplified schemes, simplified approaches of computing PGBP income, the requirement is you should show an amount which is higher than this. If you show an amount which is lower than this, then you'll have to compulsorily get your books audited. Now, the above different conditions were for businesses. Now, what if you are engaged in profession? Now, if you are engaged in a profession, then the requirement is you have to get your books audited if your turnover exceeds 50 lakhs. Again, in profession, there is a simplified scheme of computing your profession income, which is given in 44 ADA, where it says you have to take 50% of your gross receipts as your PGBP income. Now, in such cases, again, if you are showing your PGBP income, which is lower than this 50% amount, which is required in these sections, again, tax audit becomes compulsory. So what is the requirement of tax audit? One, profession turnover exceeding 50 lakhs. Two, even if the turnover is not exceeding 50 lakhs, but there is a special method of PGBP income computation given, which we call as the presumptive method, which I'm going to explain after this section. So if you're falling in the presumptive method, you have to show your PGBP income minimum the amount given in those sections. If you show an amount lower than the amount given in those sections, you have to compulsorily maintain the books and get them audited. So this is, students, about the tax audit provision. I hope this is clear to everyone. SKNM is asking, sir, here turnover means total sales of an organization in the financial year. Yes, you're right. Avijit is asking, sir, can you explain this provision with an example? See, I'll give a simple example. You are a chartered accountant firm, so you are into profession. Now, what is the logic? The logic is, if you are a big professional, and who is a big professional according to government? Whose turnover, whose gross receipts in a year exceeds 50 lakhs. So if your receipts exceed 50 lakhs, you are considered as a large professional firm. Now, once your receipts exceed 50 lakhs, the government says, get your books audited compulsorily for the purpose of income tax. However, if you are a small business, that is, your turnover is not exceeding 50 lakhs, in that particular case, you are covered in a simplified scheme of computing PGBP income, which is under 44 ADA, which I am going to explain after this. Now the rule says you should show your PGBP income minimum of the amount given in these sections. You cannot show a lower amount. If you show a lower amount, again, you have to get them audited. Right, Avijit? So 44 AD we are going to discuss. Now, after this, we are going to discuss 44 AD only, Avijit. Now, we come to the last part in PGBP, which is this. Now, what is this presumptive income? Presumptive, as the name suggests, means what you are going to presume. Means you are not going for the actual working. Now, what this section is actually aiming at? This section is aiming at giving relief to small businesses who are in the unorganized sector. I'll give you example. So around your locality, you have a kirana shop, a grocery shop selling milk. So milkman either comes to your house or you go and purchase from his shop. Third simplified example is you have a salon, a beauty treatment clinic. You have a doctor who has just started his or her practice. You have an interior decorator who has just started their practice. You have a chartered accountant, a lawyer, an architect who have just started their practice. So you have n number of examples of small businesses and professions. Now, we studied PGBP for 4 complete sections, plus you practice it at home. Still, you will require lot of practice, lot of practical exposure to actually master the PGBP provisions. Today you are understanding, that is great, but you will get more knowledge and understanding when you practice it. That will happen in your articleship and later on in your profession. Now, after so much of learning and practice, then only the PGBP provisions get clear. Now, think of or an unorganized sector business like a grocery shop, a milkman shop, a small chemist shop. That since they are small in their quantum, it is not possible for them to maintain proper books. It is not possible for them to even hire a chartered accountant for doing their calculations. Plus, since their quantum is small, they are in the unorganized sector. Unorganized sector means they are not like a corporate where everything is properly done. There is a separate person for everyone. In fact, in small businesses, in unorganized businesses, the names which I just mentioned, you'll find that it is run by the family. Family members only are in the business. They are only handling the cashes. It is not possible for them to dedicate a special person only for doing accounting and computing tax. So for them, applying the PGBP calculations is very difficult themselves because of lack of knowledge, and hiring a specialized person like a chartered accountant may not be economical. So for such challenges, keeping in mind such type of small businesses which you find n number in your place. So if you, whenever you go out in your locality, in your society, you will find n number of businesses around you, which we are, in fact, we regularly visit them. We regularly buy goods or take their services. But majority of a relief. What type of relief? They have to pay the tax. There is no exemption for them until and unless their income is below the taxable limit. They are given a relief in the sense that their computation has been made simple. What is a simple computation given? So, for the businesses which are covered in 44 AD, the simple approach given is you simply take 8% of your total receipts or turnover. This 8% is directly your PGBP income. Done. No calculations required, no reconciliation required, no calculating depreciation, no finding out scientific research, no finding out preliminary, no checking old scheme, new scheme, nothing. Simply, class, you would have been so happy about PGP chapter that wow, PGP is the simplest. Why? Because I have to simply make a total of all the sales, multiply by 8%, done. No studying any section, no studying any restriction, no checking your business majorly through banking channel. Then instead of 8%, we will take 6%. So let us say you go to a kirana shop. A kirana shop is your this year 90 lakhs are through banking channel paid me cash, which is a common feature. You also go to a grocery shop. So some people you'll find etc. So he gives you breakup that 90 lakh is through cash. So into 6%, 60 lakhs into 8%. This whole is your PGBP income. Is this understood, students? This is income is calculated for small businesses. Now, of presumptive or you are a HUF or you are a partnership firm but not LLP, and you should be resident in India. If you satisfy these conditions and you are not claiming any special deductions under 10AA or Chapter 6A Heading C, because for all these sections, you need to maintain proper books, you need to maintain actual calculation. So you are not in any of these special sections, and you are not into those businesses for which there is a separate section like transportation of business. So when you satisfy these conditions that you should be one of them, individual HUF or a firm, but not LLP, and you should not have taken any special deduction, nor are you is below. For you, this estimated method of computing PGBP income applies. So your life becomes simple. No going into technical calculations of PGBP, no understanding the complicated sections, no maintaining detailed books. Nothing is required. Simply calculate your sales, multiply by 6% for banking, multiply by 8% for non-banking receipts. Now within this limit of 2 crores for eligibility of 44AD is increased to 3 crores. Again, when major part of your business is through banking channel, that is your cash receipts from the business do not exceed 5 crore. The limit for applicability of 44AD is 3 crores. So if a grocery person is having gross receipts of 2.7 crore in a year, and out of 2.7 crore, he says, sir, 2.6 crores are through banking because nowadays everyone pays by scanning the QR code. Only hardly 10 lakhs of my receipts are in cash because there are some people who maybe a old age or for some reason they are not able to use the QR code and the scanning mechanism. So they come and pay in cash. Otherwise, my 95% plus more receipts are through banking. Then for such persons, 44AD is applicable up to the turnover of 3 crores. That is, up to the turnover of 3 crores, they can do their PGBP calculation by following this simplified method. So here again, what you will do, whatever has come through bank multiplied by 6%, whatever has come in cash multiplied by 8%, this total is your PGBP income under the presumptive method. Done. Sridhar is asking, sir, direct calculate the turnover sales or deduct expenses. See, Sridhar, once you deduct expenses, then it will become a profit. Na? I am finding out your profit. So how to find out the profit? The law has assumed that your profit percentage is 8%. Simple. So you have to take gross sales only. You don't have to deduct anything from that sales. 8% is the net profit percentage, like how we calculate the percentage of profit on sales. So 8% is their assumed percentage of profit. Understood? Clear? Good. Now, 44AD, this provision of taking PGBP on an estimated basis is not applicable. One, as we saw above, if you are into business of transportation of goods, because for that you have a separate section. Second, it is not applicable to people who are in profession, because again, for profession, we have a separate section. So there are two more separate sections for presumptive calculation. One is 44 ADA for professionals like chartered accountants, tax consultants, company secretaries, etc. Two, for transporters. So you should not be in any of these businesses. Then only you can come in 44 AD. Second, your business is not of agency. That is, you should not be getting your earnings in the form of commission or brokerage. So for agents, it is not applicable. Now, the law says estimated profit is 8% or 6%. What if your actual profit is higher? If your actual profit is higher, law says we are happy. You can show higher profit. We have no problem. So either show 8%, 6%, or show the higher amount. We are okay. But what if your actual profit is less? Now, if your actual profit is less, the law says you still show 8%, 6% as your profit. Option 1. Option 2, you want to show the lower profit. Then the law says, no problem, compulsorily get the books audited. This is what we just studied in audit above. So audit becomes applicable only to big businesses, as we saw above. However, for such small businesses for whom this estimated provision is made, for them also audit will become applicable if they want to show income below this 8%, 6% criteria. So your profit is less. One option, simply show 8%, compute your profit as 8%, and then accordingly, whatever is the tax paid. Done. You want to show lower profit only? No problem. Show lower profit, but then in that particular case, the challenge will be what? You will have to get your books audited. And obviously for that, you'll have to first maintain the books. So you increase a compliance burden, that is first maintaining books and secondly getting them audited. Now, similar presumptive provisions is for professionals. Now, if you are engaged in the profession which is specified in 44AA, what are these professions? If you remember in the previous class, towards the end, we studied provision relating to maintenance of books, and over there we studied the names of these professions. So you are a lawyer, a doctor, engineer, architect, or you are chartered accountant, or you are company secretary, interior decorator, any of these professions you are, and your turnover for the year does not exceed 50 lakhs, then you can avail the benefit of 44 ADA, provided you are individual or partnership other than LLP. So in such cases, where a person is individual or partnership and the turnover from the profession is less than 50 lakhs, then the law says you can take or compute your PGBP income by taking 50% of gross receipts. Simple. No maintenance of books, no getting the books audited, no getting into the technical working of PGBP, whatever we have studied in the previous flow 4 classes, nothing doing. Simplified scheme. Total receipts multiplied by 50%. Again, same rule. If you have higher profit, you can show higher, no problem. If you have lower profit, still the losses show 50% because that is our expectation of minimum profit. Done. But if you insist, no, I want to show the lower profit only, then the law says no problem. If you want to still claim that your profit is less, prove it. So how you will prove it? Maintain books, get them audited, right? And then coming to the last business, which is 44A, which is for transporters. Now for transporters, the law uses this language. Now, in simple words, I am saying transporters who are transporting your goods. Law says persons who are engaged in the business of plying, hiring, leasing of goods carriage. Now, see, what is a goods carriage? If you see on any truck, on the top of the truck, in a yellow patch, it is written goods carriage. This is the license they have to take from the RTO at the time of registering their truck. So whoever wants to do goods transportation business, they have to get themselves registered. And that is why many times on the trucks, you find this word written, national permit. They have to also take a permit that whether they want to operate only within their state or across India. Many trucks who are traveling across India are taking national permit. So these are the different registrations, and mainly when they get themselves registered in the RTO. So when you buy a truck, you have to get every vehicle registered with the RTO. They have to specify that we will be doing carriage of goods, that is transport of goods. And that is where they have to write here in yellow patch, goods carriage. Correct? So for transporters, the law uses this term, engage in the business of plying, hiring, leasing of goods carriage. Now, for such transporters, what is the requirement? Again, I want small business. Here, small business means they should not have more than 10 trucks during the year. Goods carriage means a truck. Now, truck means all types of trucks, right from that chota hati, which is used for transportation of goods, till the 16 tire, 25 tire truck, sorry, 24 tire truck. that is a trailer, everything is covered. That is why they have used the term goods carriage. Now, you should not have more than 10 goods carriages in a year. If you do not own more than 10 goods carriages in a year, then that transporter is called as a small business. Now, for such small business, how to compute PGBP income in the simplified or the presumptive manner? For this purpose, they have divided the trucks into two categories. One is a big truck and one is a small truck. Now, again, they have not used the word big or small. Rather, they have used the word, or they have given a criteria where your goods vehicle is a heavy goods vehicle. So what I'm calling it as big truck for your simple understanding, they have used the term heavy vehicle, and for small truck they have used the word other than heavy goods vehicle. Now what is a heavy goods vehicle? So their criteria of a big truck is the truck whose vehicle weight is more than 1000, sorry, uh, this is the estimated income, sorry. So they have given the criteria as the truck whose gross weight is exceeding 12,000 tons, that you will find here. Here they have not mentioned the criteria. Maybe in the detailed part of the section you'll find this. So a truck whose weight exceeds 12,000, that truck is called as a heavy truck, or in our language, a big truck. So the truck whose weight is exceeding 12,000 kilos, or in other words, 12 tons, that truck is a big truck or a heavy truck. And the small truck obviously will be like Chota Hathi and the small trucks where the vehicle weight is not exceeding 12,000 tons. Now, what is the estimated income? If your vehicle weight exceeds 12,000 tons, that is, you are a heavy goods vehicle, then what is your estimated income? The estimated income is rupees 1,000 per ton per month. So this is how they compute your income. Now let us say your truck is of 15 ton. So it is exceeding 12,000 kgs. It means your truck is a heavy truck. Now for this 15 ton truck, how do you compute your PGBP income under this section? 15 multiplied by 1,000, because 1,000 is per ton of the weight. So 15 multiplied by 1,000. This is for 1 month into 12 months. This becomes your estimated income of that one truck, right? So how much this will come to? This will come to 180, right? So your PGBP income for a 15-ton truck on this presumptive mechanism will be 1,80,000. So all the trucks whose weight exceed 12 tons or 12,000 kgs will be called as heavy trucks. And depending upon the weight of those trucks, take the weight of that truck in tons, multiplied by 1,000. This is your monthly estimated income, and multiplied by 12 months. Now let us say a truck you had was only for 6 months. Why? Because you purchased in the middle of the year. So you'll multiply that truck's amount by 6 months. That is simple, right? Next, what if your truck is a small truck? It is not having a weight of more than 12,000 kgs. In such cases, the estimated income is simply 7,500 per month. So for a small truck, let us say you have a 10-ton truck. So for such truck, the calculation is simply 7,500 into 12 months. This is your PGBP income for a small truck, right? I hope this is clear to everyone. Nobody has a question or a doubt with this, right, students? And then last theoretical point in PGBP is, what if your income is a composite income? Now, what is a composite income? Many times you are engaged in such type of businesses which has some part as agriculture, and I'm sure you all know agriculture income is exempt, and some part as manufacturing. Now, what could be the example? So the simplest example is in places like Kerala, Karnataka, which is rich or well famous for coffees, for various type of spices, we find that you are yourself growing that particular thing. So you are growing the coffee beans, and also you have a manufacturing unit where you crush that beans and make coffee powder out of it. So your business is what? Your business is a composite business which includes growing and manufacturing both. Now, when you are engaged in the business of growing and manufacturing both, now see, you have a single P&L, right? Now, single P&L, your credit side will be sales, one figure, which is of the final processed coffee, processed tea. And on the debit side, you have both expenses. First, the manufacturing part and also the agricultural part. So definitely the net profit that you are getting is a combined or a composite net profit, right? Now, in such cases, you don't pay tax on the entire net profit. Why? Because it is a composite income, some part is agriculture, which is exempt. How to divide this profit? The law has made it simple. So in income tax rules, they have given you percentage. This is again the assumed percentage that if you are in the business of growing and manufacturing, so first you grow the plants which give you the rubber, that what you say, glue, and from that you make the rubber products. So you are also growing the plants from where you get the rubber glue, and from that you take the glue to the factory and make rubber products. Then they assume 35 is manufacturing, 65 is agriculture. If you are in the business of growing and manufacturing coffee, now in coffee, those who are well versed with the coffee business, they will get to know that there are two types of coffees. One is so you are making coffee, but in that you have not done much of the processing. So manufacturing is 25 and growing is 75. But we have done different types of activities like curing, roasting, grounding. So your manufacturing component has increased. So now manufacturing is 40 and the growing, that is the agriculture portion, is 60. So within coffee, there are two possibilities. If it is not roasted and grounded, then it is 25-75. It is roasted and grounded, it is 40-60. And lastly, 40, they have given 40-60. So for these four types of businesses, they have given the estimated breakup percentage. So students, these are some theoretical aspects of PGBP. They are easy to understand, remember. Kindly do remember these percentages, especially for these estimated income. Remember these calculations, the percentages, so that if in the comprehensive sum, especially in the MCQ type, one adjustment may be devoted to this, or in the comprehensive sum, they will ask you to compute by both approaches. What is the both approach? By the presumptive approach and also by our regular reconciliation approach. Is this clear, students? So that is all for the PGBP side. I'm sure you all would have now understood the entire PGBP. So up till previous class, we completed all practical. Now we have come to the small theoretical remaining concepts. Fine. Chalo. Let me take you now to another very important topic. Again, important from the perspective of exam. And why important in exams? For the same reason. Again, in practice, like as I said, if you are into profession, you are doing income tax return computation, filing for your client, this is your profession, then majority of the clients who are coming to you are for PGBP. And the second, majority clients where you have to do computation is capital gain. Now, capital gain You may not get this every year because it is a capital profit. It may happen once in 10 years for a client. So definitely the number of calculations you will be doing as a professional of capital gain in a year would be for hardly out of 100, 4, 5 clients. But this chapter is very important because maximum litigation that you get in business or in relation to income tax laws is either PGBP head or the capital gain head. Very less notices you get on salary and house property. Majority of notices that income tax department is issuing today is relating to PGBP. Anyways, it is overall a important head. And the second most important head is capital gains, right? Now, other than this capital gains, all other topic students that we discuss, all those topics are revenue heads. Revenue heads means what? As you understand, because you all are student of accountancy. Account says that all your incomes, all your what you say, uh, whatever are the receipts in the business, whatever are the expenses in the business, they are of two types. What are those two types? One is either it is capital, either it is revenue. Now, on similar lines, Income Tax Act also says that whatever type of incomes you are earning, they may also be capital. Now, what are capital incomes? What are capital gains? That is what we have to understand in this topic. Now, let me inform you one thing, students. It is a myth. I repeat the word, it is a myth that every capital receipt, every capital amount that you receive will be capital gains. This is not correct. I repeat my words. It is not correct to say that every capital receipt is a capital gain. Now you'll say, sir, I was expecting that in this chapter, you will say that whatever capital receipts you will receive, you have to treat it as capital gain. But I have started with the first opening remarks of this topic saying that it is not necessary that all capital receipts will be capital gains. Now, automatically, this statement itself becomes the first challenging point of this chapter. So let me first give you some important insights about this head before we proceed. Not every capital receipt is capital gains. Now I'll say, sir, if this is your opening statement, then obviously a question comes. One, what capital receipts will be capital gains? Two, for those capital receipts which you say are not capital gain, what will happen to those capital receipts? So let me first tell you which capital receipts will fall under this head. This head has made a specific requirement. First, check whether you have a capital asset and check whether this capital asset you have transferred during the year. Now, whatever profit or loss will arise from the transfer of a capital asset, only that profit or loss will be covered under this head. So there could be some capital receipts which you may have received during the year, but it is not arising on account of transfer of a capital asset. Those capital receipts will not be covered in capital gain. Now the question obviously would be, sir, then what happens to those capital receipts? Answer is simple. Either those capital receipts are covered in other heads like PGBP head covers some capital receipt, salary head covers some capital receipt, and even other sources heads cover some capital receipt. So except the house property, remaining three heads, salary, PGBP, and other sources, they cover some capital receipt. I'll give you an example of one or two. Now you have studied salary. So you have studied gratuity. You have studied retrenchment compensation. All these are capital receipts which are taxed under the head salary itself. Similarly, under PGBP, if you remember section 28 when we were discussing, you covered compensation on termination or modification of your business management rights or termination modification of your agency business rights or the non-compete fees. That is, somebody is paying you an amount and asking you not to compete with that person. All these receipts are capital receipts, but they are not covered in capital gain, but they are covered respectively in PGBP. And similarly, when we'll study other sources after this, I'll identify and I'll tell you what are the capital receipts covered over there. So what I'm trying to tell you is, don't be under an impression that every capital receipt is a capital gain. No. Only those capital receipts which satisfy these two basic conditions are capital gain. And what are the two conditions? One, the receipt has arisen because you had a capital asset and when the capital asset was transferred. So when both things happen, or in one line, whenever transfer of a capital asset happens, then on the transfer of this capital asset, whatever will be your profit or loss from the transfer will be covered under capital gains. Obviously, there are some exceptions to this. There are some restrictions to this that we'll study later. But the first most basic condition is this. Chalo. Anybody has any questions or doubts up to this point before I can proceed? Students, I'm expecting that there would be a lot many questions because capital gain is again a very vast topic, but at the same time, it is very, very, very interesting topic. So Anchal, this is what I want to know. What you did not get. Can you specify? You can unmute yourself. See, I'll give you a simple example. We understand in accounts what is an asset, right? Now, what is an asset in accounts? Land, building, plant machinery, gold, jewelry, shares. All these are assets, correct? On similar lines, these are capital assets that we'll discuss as we proceed with the definition, right? What is transfer? Again, this you would have studied earlier in economics, in your Sale of Goods Act. Transfer, in very simple words, is you giving away something to another. Now, it may be by way of sale. The most common thing we understand is sale. So, simple example, beta, that you have a building. Let us say today you are having a house. You want to now shift to a bigger house. What you will do? You will sell this existing house. So, when you sell, that is a transfer, and the house that you are having is a capital asset. The moment both these conditions are satisfied, capital asset is transferred. This triggers this chapter. So when you have to check or come to capital gains, first these two conditions should have been satisfied. So check whether whatever you have is a capital asset or not. We'll see the definition. Two, have you transferred that capital asset? Only when both these things happen, capital gain chapter is required. Until both these things happen, you will never come to capital gain chapter. So simply owning a capital asset, like today you may be having shares, you may be having gold jewelry, you may be having properties, will not trigger capital gain. Yes, it is a capital asset, but it will not trigger capital gain chapter. When you will come to this chapter for doing computation, only when you have sold these assets. Correct? Simple, students? Good. Okay. Aditya will not get into that distinction, whether it is PPE, whether it is current assets, because That type of distinction is not made by income tax or capital gain chapter, right? Now, I'll first show you the computation. Again, why? Because see, whenever you look at things practically, understanding the theory becomes easy also and becomes interesting also. So as I said, first check whether capital gain chapter applies. And to check this or to go to the computation, you have to check whether there was an asset. So we'll have to check the asset definition. And second, is that asset transferred by you? If both things are satisfied, we have to compute capital gain. Now, what is the format? You first have something called as FVC, full value of consideration. I'll say, sir, what is this? In simple words, your sale value. From this, subtract expenses on transfer. Let me call it as EOT. Now, what is it? Now, many times when you are transferring something like a building, property, you may not know the customer directly. So you appoint an agent and you have to give some commission to the agent so that the agent gets you a customer. Or many times you put advertisement in newspaper. Through advertisement, you get the customer. And so these expenses are required so that you get a customer and you can sell the asset, right? Similarly, many times when these assets are sold, you have to do registration, you have to hire a lawyer to prepare documents. So all these fees like registration fees, legal fees, all these becomes expenses on transfer. That is, without these expenses, you could not have sold your asset. After subtracting this, what is left is called as net consideration. Let us call it as NC. Right? And from this, now see logically, how will you calculate profit or loss on sale of any of your asset? Let us say you had purchased shares and now you have sold it. How will you find out profit or loss? Simply from sale value, what you have to subtract? You have to subtract the cost price. So simple, na? You had purchased shares for rupees 100 per share. Today the price has increased. It has become 122. You sell it for 122. But out of that, 2 rupees you have to pay commission to the broking agent because you cannot sell shares directly. You have to sell it through the broking agents. So you pay 2 rupees commission. So how you'll calculate, how you will say that how much you have earned on the share, like people normally say, I earn so much on share trading. So 122 they get from the sale, 2 rupees they have given commission. So 122 minus this 2. So their net consideration which they have received in their bank account is this. And they had purchased the share for 100. So they will say, okay, I've earned 20 rupees per share. Now, if they had 10,000 shares, they will say, today I earned 2 lakh rupees. Because on every share, they got 20 rupees multiplied by 10,000 shares. So they earned 2 lakh rupees. So it is so simple and so logical. The only thing is they have used some jargons like full value of consideration, which is nothing but sale value, expenses on transfer, which includes all these expenses which are required for selling that asset. And for cost price, they have used the term cost of acquisition. In short, we'll call it as COA, and cost of improvement, COI. Now you'll say, sir, we understood what is cost of acquisition. What is cost of improvement? See, since we are talking about a capital asset, it is a possibility. Like I talk about your house. You may have purchased this house in 2004. Your parents would have purchased it then. So now it is more than 20 years. So at that time, they purchased it for 25 lakhs, which is the cost price. After purchasing, maybe let us say some 10 years before, somewhere in 2016, they have done some capital expenditure on its extension. So many times what we do, we enclose the balcony or we put some artificial roof and we may convert the terrace into a room. Now, on that, whatever expenses they made, you understand that even in the eyes of accounting, this is a capital expenditure because it has led to increase in the life or the value or the efficiency of the asset. So such capital expenses which are incurred later after you had already purchased and made the asset ready for use. After that, in future, whenever you do some capital expenditure, what does accounts do? They will add the cost of that capital expenditure in the value of original asset. Here, what we do is we show it separately and we call it as cost of improvement. Now, it is not necessary for every capital asset you would have done this, but there is a possibility that for some capital asset, some capital expenditure was done later. Now, after subtracting both these costs, what is left is nothing but your profit that you have earned on sale of this. And this is what is called as a capital gain. Now, if by chance today there was a loss, you will call it as a capital loss. Correct? So this difference, sale value minus expense minus both the cost, the difference is your profit or loss. Now, in income tax, there is an interesting distinction, that is whether this asset which you have sold today was held by you for some minimum period of time. If the answer is yes, then we call that asset as a long-term asset because you had held it, you had kept it with you for some minimum period of time, and after that only you sold it. So it is a long-term asset. But if you have sold it, you purchase it and sold it in 6 months, 10 months, that is, you have held it for a very short period of time and you have sold it, we will call it as a short-term asset, and obviously the gain or loss arising from it would be short-term. So this is the calculation. Now, if you don't look at the left side, which is the technical word, so only if you see what I have written here, you will understand the calculation. And let me tell you, the best part of capital gain chapter out of all heads is, this is the most smallest working in your paper. Because many times, as I said, this may not be there. Many times this is not there. It is simply this minus this. So simple, so straightforward. And interestingly, for such a small working, the marks are 6, 8, at times 10. That is the best part of this chapter. So students, now tell me, what are your queries? Now I've even given you some real life simplified examples. In fact, in your exam sums also, same examples are given, obviously with some technical details, which now we have to learn and prepare. SKNM is asking, if we take loan against capital asset, under which head it will go? See, loan is a liability, right? Now, in any head, there is no place for showing a liability. What you show receipt, what you show expenses. Receipt minus expenses is your profit. Now here, we are covering capital receipts and we subtract the capital expense, which is the purchase cost. Loan is not a capital expense. You do not say loan is a capital expense, it is a liability. So you have to repay the liability over a period of time. So NM, nowhere the liability or the loan will be shown. Sridhar, NM, even in PGBP, we do not show the liability. Now we have completed PGBP. Anywhere did you see me showing the loan? So even in PGBP, loan is having no place. Where till now we completed everything in PGBP. We read so many sections. Where did you read anything about loan? See, understand one thing, NM and everybody. I had mentioned this in one of my previous classes of PGBP. There is nothing like a balance sheet in income tax. We don't have any income tax balance sheet separately. Whatever balance sheet we give to the income tax department is our accounting balance sheet only. Yes, we do have a separate calculation of income, which we are studying in various heads, but there is no separate balance sheet over here, right? Is this clear? Just a second, please. Yes, what are your further queries? Sir, in trading, STT and brokerage, both charges are included. See, that is what we will study now. What is allowed, what is not allowed, like PGBP. Here also there are some conditions and rules. That is what we'll study. Right? So whether the STT paid is allowed or not, that we'll study. Na? That is what is our technical discussion. But before I go to technical, let us first understand it practically. Let us first understand it in the real life scenario. Like here, I took two examples. One is of share trading, one is of your house. Now, when we go to the technical part, that is the provisions part, now we will understand what is covered, what is not covered. Vijay Kumar is asking, sir, cost of acquisition explain. But a cost of acquisition, see what I have written. What is cost of acquisition? See what I have written here. Cost of acquisition is your purchase price, the price at which you had purchased that asset. So I give example. You have sold shares today for 122, which is your full value of consideration. But we also see now at what price these shares were purchased. You had purchased it for 100 rupees. So 100 will be called as cost of acquisition. Similarly, for your house, you had spent 25 lakhs when you had purchased the house or constructed the house. So 25 becomes your cost of acquisition. Correct, Vijay? Aditya is saying, sir, dividend. Okay. Now, Aditya is asking whether dividend will be short-term or long-term capital gain. Again, everyone, whenever you're talking about capital gain, the first thing you check is this, whether capital gain head is applicable. And when capital gain head is applicable, when this happens. Now, I want everybody to answer Aditya's question. Aditya has asked me, sir, whether dividend will be long-term or short-term. Students, what will be your answer? Whether dividend is short-term or long? See, we can understand from others' doubts. Very good, Enam. Very good, James. Others, help me answer, Aditya. Yes, Arun, very good. Very good, Isha. Yes, correct. Kambira, no, Kambira. Sorry, you're wrong. Yes, Anil. No, Dhanlakshmi. Correct, Akash. No, Sridhar. So, Mehak, exactly what you mean to say, I did not get you. Okay, correct, Vishakha. No, Isha. No, Aditya. So, Anshika, what it is? Mehak, sorry. See, students, I already gave you the answer. What is my answer? What did I say? That before you conclude anything, now you have directly come to the last point, saying that dividend is long term or short term. But before that, first check whether you fall in capital gain chapter. When will you fall in capital gain chapter, Aditya? When you have an asset. Now you'll say, sir, I have an asset. What is that asset? Asset is shares. Great. So you have an asset as Aditya? Yes. Now, how did you get dividend? Did you get dividend by selling the shares or by just keeping the shares? Did you sell the shares? No. Now, if you have not sold the shares, is my second requirement satisfied? No. So whatever you are getting from these shares, which you are calling as dividends, is it arising from transfer of the shares? If it is not arising from transfer of the shares, it cannot be capital gain. Then you'll have to see whether it is PGBP, other sources, whatever. But at least it will not be capital gain. That is why I first started with this point. you have to check whether capital gain head applies. See, this is what happens practically also, students. As you read the word shares, as you read the word house property, as you read the word gold, silver, the first thing that you think is capital gain. Sorry, these are assets, I agree. But when you will come under the capital gain, only when you have sold them, which is called as transfer. Now, transfer includes many other mediums, but the most simple and the common one is sale. Have you sold it? If not, there is no question of capital gains. Correct now? I hope it is clear to all. Good. Vishaka Beta, you sell the shares, right? Now, when you sell the shares, there is no dividend coming on the shares. Yes, I know you have studied in accounts in AS 13, but that is what happens. There is some accrued dividend on those shares. So you ask the buyer to pay you that accrued dividend. But is that the sale price for the share? Answer is no. So that accrued dividend which you are taking from the buyer, either the dividend or the interest, let us say in case of debentures, will always be your other sources income because it is not for the sale of those shares. Correct? Arun has put me a question. Tax is required to be deducted on or before 31st March. The TDS deducted should be deposited on or before filing returns. Could you please explain how we can verify whether TDS was actually deducted on or before 31st March? Very good question. See, Arun, practically it is, you have to check the journal entry. If the journal entry is showing that you have deducted that amount, and also, I'll tell you the second way. This amount, if deducted, you will get that reflection in the ledger account because to that extent, less amount will be paid. So the deduction, whether it is made or not before 31st March, as you have rightly pointed out, practically it is a provision base point and it can be checked only by seeing the journal entry. Is this fine, uh, Arun? Right? And third interesting point about this capital gains. Now see, we have many sections, many provisions. Like how we had multiple sections and provisions in PGP, this chapter is also full of sections and provisions. The best part is whatever you study, every provision. Why I'm telling you this, just you have to keep in mind that whatever we'll be studying, everything that you study in capital gain will have some exception. So that is the best part or the most interesting part. And that is why even for such a simple or small calculation, you are given 4 marks, 6 marks, 8 marks. Why? Because you need not only know the main provision, you also need to know the exceptions. Because every provision comes with some carve outs, some exceptions. So this is a very unique aspect of this chapter, which wasn't present in other chapters. This chapter, whatever I am saying, whatever I am explaining, every point will have exception. Like I'll simply, I told you that this is the requirement. When this is satisfied, there should be capital gain, right? However, later you'll find that even though both conditions are satisfied, still in some specific cases, there is no capital gain. Why? Because that is an exception even to this point. Similarly, I have shown you some working here. Now, for this whole working, there are exceptions. For individual points, like all these terms, we are going to study separate provisions, which will explain full value, which will explain cost. Whatever you will study, okay, that this is how to compute full value, there could be some exception. So what are those exceptions? Those exceptions are some special cases. Because see, when we talk about capital asset, it is such a vast point that you have so many things in capital asset, and you will sell the capital asset, you will transfer the capital asset. Now, within this whole vast thing, there are some special or unique transactions which the government wants to tax in a different manner. They do not want to tax them in the regular manner. So those transactions, those situations, they have put as exceptions. So just remember that whatever we study in capital gain, everything will also have an exception. Fine, students? Okay. Now, how we will proceed with this chapter? Now I have given you the whole scenario. Now we will do fill in the blanks. What is fill in the blanks? Now we'll study one thing in detail. Capital asset, transfer, then full value, then expenses, then cost, what is long term, what is short term, everything written on my screen. We will study each one of them in detail. So first I've given you the overview. This is whole capital gain chapter in short. Yes, there's something else here, but I've purposefully not included it here because still we are at a very initial stage of this chapter. So I'm just writing it, but I'm not giving you the details because I do not want to confuse at the start. But this is the complete calculation. And as I told you, in many of the sums, all these data may not be there. One or two data is there. Plus, there is something here also. I'll just write the word. I will not explain it now. I do not want to mix up too many things. But let me tell you, besides this whole page, whatever is there in this page, there is nothing else in capital gain. The entire capital gains is this much. See, so I've made it very simple in one page. Now, from now onwards, we will study each of the points in detail. So now I'll fill in the blank everything. What is a capital asset? Detail. So then you'll have provisions, you'll have some exceptions. Transfer, detail, provision, exception. Full value, cost of acquisition, improvement, everything in detail and with their exceptions. Perfect, students? All set? Is the backdrop clear of capital gains? Yes, students. Excellent. Aditya, you'll get to know everything. So he's asking, sir, if gift given to jewelry or house. So that is what I'm saying, special provis, special situations. If gift is given, what will happen? You'll get to know. Those are the special cases, right? Chalo. So same like PGBP, I've first given you the entire picture. Because see, these are vast heads. Many times what we do is we start studying each section. But when you start studying each section, you get lost in the ocean of that chapter. So first, let us understand the whole chapter from a bird's eye view. Now, when you know the whole chapter, now fill in the blanks, you will understand better. Fine. But before that, let us have a break so that at least mentally now we are having a break. So after the break, now when I go to each part in detail, it will be one thing at a time. Fine, students? So let us have a break. of the topic, let us now proceed to the detailings of this topic. As I said, for this head to be applicable, two things are most important. One is a capital asset, second is transfer. Now we start with the definition of transfer. I've already mentioned transfer is what? In very simple words, it is giving away of the asset to another person. And we all know the simplest mechanism of doing is sale. But there could be other mechanisms. What are those other mechanisms? Let us understand. Correct? Now we'll go to the module. So from here, the module part starts. Now see, you can see some working at the start of the module. Definitely. Now you can start studying the module also, though certain things may not be very clear because in the format they have given everything, the entire chapter. Something may not click to you, but that is okay. Still, you have to start reading the module. Now, what I just skipped was the capital asset definition that we will understand after understanding transfer, because there are some points of transfer which when you understand, then understanding capital asset will be easy because it is linked to those parts of transfer. Now, what is transfer? Section 2, clause 47. Now, please remember, students, we are all studying the 1961 Act. Next year onwards, it will be the 2025 Act. Let me make one thing very clear. There is no change as far as the concept, the logic is concerned. There is no change as far as the provisions is concerned, except what amendment happens every year through budget. That is anyways common. The only thing that has changed is the language. So now what we are studying, you will find some sections drafted in some very technical legal jargon language in the new act that has been simplified. Second major change that you find is the redrafting of section numbers. Because now, since this was old act, 1961 act, at different points of time, many sections were added. How they were added? By using alphabets. Like in PGBP itself, we have studied section 43B, 40A. So many sections where numbers and alphabets both come together. That has now been removed. Now you will have all these section numbers in numbers only. Again, wherever amendment happens again in future, there may be again new sections coming with alphabets, but otherwise what has been changed in the old and the new law is only the cosmetic changes, as we say. Nothing major has changed in the content part. Why I'm emphasizing this? Because many times students who are studying in this year who will be appearing in their upcoming exams, they are having an apprehension that, sir, we will take a lot of efforts in studying this law and suddenly the entire law will change, so all our efforts will be waste. Answer is no. Your only efforts that will change or will require modification is the efforts on the section number. Content wise, nothing has changed. Let me make that simple and clear to everyone. Now, what is transfer? What they have simply done in this definition is they have given you the different forms in which you can give your asset to another. So as I have been telling you, what is transfer in the most simplest sense? It is giving away your asset. Now, how you can give away your asset to other? Sale, exchange, right? Now, these two terms you understand. Now we come to some new terms and new concepts. Relinquishment. Now, this may sound technical, but it is simple. See, in sale or exchange, you get something in return. In sale, you get money. In exchange, you get another asset, right? Relinquishment is that form of transfer where you are giving away the asset without anything in return. Like, I have gifted my asset to someone. I have donated my asset to someone. This is what is the simplest example of relinquishment of asset. Now, when we will proceed, as I said, every section has exceptions. So you will find that just now the example which I gave you of gift has been treated as an exception to transfer that we'll study. But right now, For explaining you relinquishment, the most simplest and the most practical thing which I could think of is gift. So I've told you that what is covered in relinquishment is gift. However, below as we proceed, you will find that it has been excluded from transfer. So what it means that we'll discuss. But first form of transfer is sale, second is exchange, third is relinquishment. Now coming to fourth form, extinguishment of rights. Now what is this? See, this generally happens whenever there is a joint property. Now let us say it is a joint flat which is owned by two people. Now these two people may be husband, wife, maybe brothers, whoever, or parent and son, parent and daughter, whoever. So many times it is very common that properties are purchased jointly. So this is one whole flat or a plot of land, and there are two owners. Now importantly, in such cases, you will find that when we say that there are joint owners, it means they have not made a physical division that, okay, this is mine, this is yours. No. If that is the case, then there is no problem, because then there will be two assets. This part of asset is mine, so this is one asset. This part of asset is yours, this is another asset. Then there is no problem. The problem is it is a single asset with two owners. They have not physically divided the asset. Like a flat, it is impossible to divide a flat into two parts, right? Now in such cases, let us say these two brothers are having dispute, and as a settlement of dispute, what is agreed, that one of the brothers will give away his share in that particular flat to the other, obviously for some compensation. Now what does this clause 2 covers is exactly this situation. So what this second brother has agreed to do, has agreed to extinguish his rights in the flat. So technically he has not sold the flat because he is not owner of the whole flat. So technically he cannot sell it. But what he had done, whatever were his part of rights, his part share in the flat, he has extinguished them. What is extinguishment? Extinguishment is putting to an end. Here it means by making an agreement, he will say that now I give away my share in this flat. Why? Because my brother is ready to give me 50 lakhs for that, and I do not want dispute. So I'll take my money and I'll go and buy some other flat. But in this flat, what I have done, since I'm not the owner of the complete asset, I'm only having a part ownership. I'm one of the joint owners. So I have only one option to sell. What I can sell is my part ownership rights. That is what is the fourth form of transfer, where the entire asset could not be transferred, but what you have done is in that asset, whatever were your rights, you have put an end to it. Obviously, how? By making an agreement and saying that, okay, I put an end to my rights. Against that, I'm taking some compensation. So this is the fourth form. Students, see, now we are in the technical part of the provisions. And here you will come across many such things which till now you have never thought of, you have never heard of. Why? Because see, you are still studying, you are still not yet exposed to the real commercial world. That you will do once you get into articleship, once you get into your profession. So here you may come across many of such transactions, which even in accounts, which even in other topics you have not yet studied, right? But that is what is the beauty of this chapter. This chapter gives you a real life picture of how different transactions happen. So as you saw in the first 2 points, there are four situations how you can transfer your asset. Now this is the fifth situation. Now again, what is the practical example of this? See, I'll try to give you real life examples so that these technical things are easy to understand. Now we all are hearing that in India very soon we'll have a bullet train, and it will be between Ahmedabad to Mumbai. Now I'm sure you all would be knowing this, that the bullet train cannot function, cannot run on the present tracks, because for bullet train, the entire technology, everything is different. So obviously you require a different infrastructure. Now, for a bullet train to function, one very important thing which the government is doing, which is consuming the most of the time, is setting up the entire railway track or bullet train, which will be independent, which will be separate of your present entire railway infrastructure. Everything will be different, like how you have seen for metros. Wherever metros have started, you have seen that entire separate metro line has been set up. Similarly, for this bullet train, there will be an entire whole network. Now let us say on this route, there is one plot of land. There would be, this route is long, it is around some 500 kilometers. In that, wherever this route is planned, it is not necessary the land which is falling in the way of this route is of government. No, majority of the land is of private persons like you and me. So let us say I have my plot of land, and from that plot of land, some railway track is passing, this new project is passing. Now, if the government wants to construct this whole railway line of 400 plus kilometers, it will have to first purchase these land, whatever are falling on the way. I hope you understand this. Only then, after the land becomes the ownership of the government, then they can start constructing the railway line and the entire infrastructure. Now, in this particular case, there would be thousands of people whose property is on that route. Do you think everybody will themselves agree to give it? More than 50% may not agree. They will say, why should I leave my land? This is my inherited land. This is land which my ancestors of four generation were living in. I don't want to give. That is why there is a specific law which empowers the government to compulsorily take away your property. That is what is called as compulsory acquisition when it is in the larger public interest. So that is what is the Land Acquisition Act, which empowers the government to compulsorily take your property. Now, obviously, this is not free because it is your owned property, it is your legal property. So government can take it compulsorily as per this act, but obviously after giving you some compensation. So here again, transfer includes this type of transactions also, where maybe you may not be ready to give away your property, but because of the power under this particular section, the government has compulsorily taken up your property. This is what is compulsory acquisition. I hope, student, this situation or this type of transfer is clear. Now coming to something even more interesting, even more different, because at least in all the above four scenarios, something actually got transferred. But in this scenario, which we are going to cover now in class 4, in reality, nothing has got sold to anyone. The asset is still with you, but the law is deeming, assuming that the asset is transferred. This is the beauty of this particular point. Now you'll say, sir, what is this special thing? Now law has written something that capital asset converted into stock in trade, what it is. Let me give you again a real life example. I have a plot of land. Now it was purchased, I'm giving you a real life example in my case, which was purchased in 1914. So today it is more than 100 years old by my great 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 grandfather. When he shifted to this place, he purchased that plot of land. At that time, that particular area was a very outskirt area. It was virtually a jungle at that time. There were everything, trees and everything, no proper roads and all. In this span of 100 plus years, this has become the prime location of the city. Now, this is a common thing with many of us, whoever is staying in Bangalore, Hyderabad, Mumbai, Pune, those who have had old properties, maybe originally the property was in some remote location because at that time the cities were very small. But because of the expansion of cities, now your property is in the prime location. Now, in this case, now today, I want to sell the property. Now, when I check the market value, it is 100 crores. At times, it may be even more. I'm very happy, but at the same time, I'm concerned with the taxation because this property was purchased for some few thousand rupees by my great 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 grandfather. At that time, it was valueless. It was very negligible value. Now, today, if I compute, everything is capital gain and it will be a huge taxation. So, people started doing some jugad. Now, what jugad people did? What they did is that this is a capital asset. You all will agree because it is a plot of land which I am owning over a period of time. So obviously it is my property, it is my capital asset. What people did was that immediately they did not transfer it as it is. They first showed that they have started a new business. What is the business? Business is property dealing. Now please understand what has happened. Now I start a new business which I call as a property dealing business. Now, whenever you start a business, you bring in capital. Now, what is the journal entry which I passed? I passed land to capital because I introduced this land itself as a capital. Many times we have done this, you have studied this in accounts, in partnership, in proprietary concern, that you start your business by introducing some asset as your capital. Now, what I did smartly was when I was passing this entry, I put the value as 98 crores, 99 crores. And now in my balance sheet, capital 98 crores. And this land, which is now appearing as my stock in trade. Why? Because my business is of property dealing, and this land is now a land which is for sale further as a stock. So this land is appearing here as a stock in trade. Now, interestingly, what I did was that I simply changed the character of my asset, which was an asset, which was a capital asset, to stock in trade. And why I did it? So that suddenly what this asset cost to me was some 1,000 rupees, let us say 15,000 rupees. Had I sold it now, this difference would have been capital gain, 100 crores minus 15,000 rupees, which would be 99 crores and 99 lakhs and something. I first shifted this asset into my business only. So nothing is going out of my control. It is still with me. The asset is still with me, but now by a name that is stock in trade, right? And while doing this conversion, means shifting it from asset to stock in trade, I change the value. Now, interestingly, if you understand this particular mechanism, what I achieved was that now I am saying this is my stock in trade. The moment I say this is my stock in trade, this becomes an item of PGBP, because now in future, whenever I'll sell this, this will come under the PGBP head because it is a stock in trade and sale of stock in trade is a PGBP income. So now when I sell it after 6 months, 1 year, 2 years after doing this jugad, I will say that, okay, I've sold it for 100 crores. My books show costs of this asset as 98. Not now my asset, now my stock in trade as 98. So only 2 crores is PGBP income. Simple. People started doing this. And interestingly, this part where this asset, which was originally as asset, is now shown as stock in trade. This conversion, now see, when you are saying conversion, please understand physically nothing is happening. That same plot of land, which is in a idle at some place, or maybe today I am staying over that plot by having a small constructed house, it is still as it is. Only in my books, the category changed from capital asset to stock in trade. And since earlier also the asset was with me, now also the stock in trade, converted this asset is with me, nobody will say there is any income. But what I did smartly was in this change of categorization from asset to stock in trade, I smartly inflated the value to 98 crores. So that now when I sell it, I only have income of 2 crores. When income tax found out this type of adjustments happening, this type of jugaad happening, they brought in this clause in the definition of transfer. And now the transfer says, whenever you do this type of jugaad, what you did, your asset, now you are showing it as stock in trade with you only. Till on this date, you have not given it to anyone. That you will give it in future. That future will be PGBP income. But today, when you have changed this category, the capital asset which you are having, you are now calling it as stock in trade. This conversion will be assumed, will be deemed to be a transfer. Now, see, students, we are entering the special transactions category where the same thing is now looked at from a different perspective. If you see plainly without having this backdrop, you will say, sir, what is this? And rather, why is this? When the asset is still with you, how can you say it is a transfer? Again, I repeat, in reality, there is no transfer because till date I have not given it to any outsider. But this conversion in my books only from asset to stock in trade, I inflate value so that I do not have to pay tax to avoid this type of jugaad, this type of, in fact, tax evasion jugaad. The law had to bring in this particular provision in transfer. Students, I hope you understood the section, the transaction, and also why this transaction is transfer. Is this clear? Yes, Ramakrishna.
Sir, actually, you told that the land to capital in balance sheet, capital is liability side, and in fixed asset side, land will be there. No, so how come from fixed assets to stock in trade, the transaction will happen?
Please understand, Beda, this asset, there is no balance sheet. See, are you showing your personal house in any balance sheet right now? No, there is no balance sheet yet. Now, see, we prepare balance sheet only when we start a business.
Okay.
Correct. Also, chalo, let us assume there is a balance sheet. So there is some capital and also this land is appearing here.
Yeah.
What I will do, I will shift it here in stock in trade. Whatever is the difference, I'll add in my capital whenever I have to do this. So assuming even if it is a business land, let us say a land which was already appearing in business balance sheet, still people were doing this. They were shifting it from here to here, right?
Right.
While shifting here, it was 15,000. Here they made it 98 crores and whatever was different, they added in capital. So both possibilities. Earlier, it was my personal, not part of any business, now showing it in business. Or even if it is originally business, but while doing this categorization, I added the amount in capital. Correct, na? Possible, na?
Yes, yes, yes.
Right? Understood, Ramakrishnan? Now comes the main point. This we'll study in the later part, but just to complete this, because somebody has asked me this in the question, Kisan, now how will you tax it? See, firstly, what I did, I made this transaction a taxable transaction under capital gain. Because when is capital gain applicable? We just understood there should be an asset. Yes, I had this land, which is my asset, and it is transferred. What is this transfer? Now I'm converting, I'm treating this conversion is as transfer. So in the eyes of law, capital gain has triggered. But they say, this you'll study later as we proceed, I will not tax it now. We will wait for the date till it gets actually sold to some outsider. Because today, even after conversion, you are the owner. So there is no outside party. And we cannot tax you until you actually give it to some outside party. So we will wait. Now, what will happen in future? After 6 months, 1 year, 2 years, whenever I will actually sell it to an outsider for 100 crores. Now, how this will be taxed? This difference, 98 to 100 crores, will be the PGBP income because now that particular item is appearing as stock in trade, and whatever is profit on stock in trade is PGBP. And in that year, when this particular actual sale will happen, this difference you will tax in PGBP, and this difference you will tax in capital gains. That is how this will get taxed, Akash. Right, beta? I hope everybody else also understood this. Clear to everyone? No doubts? Should I proceed? Yes, students, please confirm. We are in the most interesting chapter of your entire syllabus. Isha, what is SP? Nisha, what is SP? Yeah, correct. So you will tax it only when it is actually sold, because only then you can say I have realized the money. Till now, I have only inflated in my books. See, it is like revaluation in your books, in other words. Correct? James is asking how they can show 98 crores. See, James, understand one thing. Again, you all are mixing two things. I am showing you books so that you understand, because you all are student of accounts. When people are doing this jugaad, it is not necessarily they are showing it in books. Secondly, wherever they are showing it, who knows what is the actual cost? Only you know, na? That is what is the point. Who knows what is your actual cost? See, understand my example. My asset was purchased 100 plus more years before. Who knows the actual cost? So I already mentioned, James, these are all jugaad provisions. These are all done for tax evasion. So when it is tax evasion, why will they follow the accounts rule of showing the inventory at whichever is less? See, please understand, you have studied this as a rule, but people don't follow rules. And that is where you and me are required as professionals to tell them that firstly, this is the rule. And second, if they are breaching the rule, this will be the consequences. Correct. So you studied stock is valued at whichever is less. All that is theory. You have to understand one thing in practical. Firstly, how many people know accounts? Even importantly, interestingly, people who are doing business today, they have not studied accounts. You have studied accounts now when you came to commerce. But people who are doing business, they are either not educated, they have not studied commerce, they may have studied science and then started their business. And lastly, even if they have studied commerce, but they don't want to follow, because this is already, I mentioned, it is a jugaad, it is a tax evasion situation. Yes, obviously, if your any person, Gopal is sorry, Sridhar is dealing in land and building, then land and building becomes your stock in trade, beta. Arun, which rule 2001 you are saying? I don't know what is 2001 rule you are mentioning about. Please clarify. Let us proceed, students. The next one is simple. Wherever you have purchased a bond and whenever the maturity of or redemption of the bond will come and you return back the bond to the original company, that maturity or redemption will be treated as transfer. In short, the difference that you'll get on the purchase and redemption of this bond will be your capital gain. Now coming to again a very interesting scenario. Again, what the module says, part performance of contract. Now, what is this? Again, let me give you a practical example. So a multi-storied building is getting constructed. Now, many times you'll find that the ground floor, which is many times constructed as a shop or as a commercial entity, you book this shop, right? Now, when you have booked this shop, the building construction is still going on. Now, there is some auspicious date coming. So when you book this shop, you tell the builder, ki boss, I want the possession in June on this date. Why? Because it is auspicious and I want to start my business on that date. The builder says no problem, even though the building will take 2 years, but since this is ground floor, it is already first constructed. Already, as you can see, the structure is ready. Only I have to complete the walls, tiles, paint, everything I'll do, and I'll give it to you in June. Now understand one thing. What you have done is you have purchased an immobile property. So shop is an immobile property, yes, but the building is still under construction. Now, in the eyes of government, which government? The local government, which we call as municipality, municipal corporation, who authorizes the construction of this building, they give something called as a completion certificate. Just keep this in mind, understand this. This will also be useful in other laws, especially like GST. So what is a completion certificate? So you want to construct a building, you have to first get the building plan approved from the municipality, who will check whether you are following the present rules and regulations for construction of building. And if you follow that, they will give you the first permission, which is called as commencement. Now, after getting that permission, you start constructing the building. And once your building is completed, again, you go to the corporation, show them all your documents, ask them to do the physical verification of building, and they will come and verify to again check that whether your building is actually constructed as per the rules, regulations. And once that is satisfied by them, they will give you the final certificate called as completion certificate. This completion certificate is the proof that yes, actually, finally, your building is completed and ready. Fine. Now coming to our laws, whether it is Contract Act, whether it is Transfer of Properties Act, and whether it is Taxation Act, both income tax, GST. In all these laws, until the building is under construction, we assume that there is no saleable product. Now I'm using the word product. There is no saleable product. We assume this, right? Now pay attention. Practically, already this shop is sold, because even though the building is under construction, since it is ground floor, it is completed, because you start constructing from ground floor only. You first make everything on the ground floor and then you proceed. So this is physically completed, and hence the builder could sell it to you physically. I'm purposefully using the word physically because physically the builder has given you that possession also, that okay, you start using the shop. But legally, in the eyes of all these laws which I mentioned, Contract Act, Transfer of Properties Act, Taxation Act, the building is under construction, so everything is work in progress. Now comes the main point. Transfer of Properties Act, which is the main governing law for such type of transaction, because this is immobile property and you are purchasing, selling it. So you fall in the Transfer of Properties Act. In short, we call it as TOPA, Transfer of Properties Act. Now, in that law, originally when the law was made, there was no provision for such type of transactions where the building is still under construction, still some part of it is sold. Later on, when disputes started arising, now what type of disputes? That I have been given physical possession, but legally there is no document in my name. Why? Because as I already mentioned, in the eyes of law, the building is not complete. So how can the builder sell it? Now, many places, builders or whoever was the owner of this shop were misusing this lacuna in the law. What misuse they were doing? They sold it to me, they sold it to somebody else, they sold it to somebody else. So same thing was sold to 2 3 people. Why? Because legally there could be no document registered in my name, because the law did not consider it as complete. Now this was leading to a lot of fraud and challenges. So the Transfer of Properties Act was amended and a new section 53A was inserted. Right? Student, just give me a minute, please. Just a minute, please. Yes, students, sorry. Now, Enam is asking in real life how capital gain is calculated. We go to sub-registrar. So Enam, I'll tell you the value. See, we are coming one by one, right? So right now we are discussing the transactions on which capital gain will be applicable. Then we'll go to the valuation. So let me not mix everything, because if I start explaining everything now, things will go out of control, right? So let me go step by step. Right now, I'm only on one fill in the blank. What transactions will be covered under capital gain? The answer is transfer. But exactly transfer means what? So all these transactions are transferred in simple, correct? Still, if you want answer to your point, try to recall, go and check 43 CA of PGBP. So your answer is in 43 CA of PGBP, which we have already studied. So there you will get your answer. Right now, I'm not mentioning it because I do not want to diversify. So coming back to this point, so now this act has introduced a new section 53A, which says that even transferring a property which is under construction is to be treated as transfer. This is what they have technically referred as part performance. So here you'll see in the explanation, sometimes possession of amiable property is given in consideration of part performance. What is part performance? They would have explained here in example. So wherever under construction building is given, this will also be treated as transfer. This amendment is relating to Transfer of Properties Act, but now income tax law says if they are treating it as transfer, we will also treat it as transfer. So in short, even under construction building is transfer. Now coming to the residuary provision. Now residuary provision, where when we say that anything is residuary, when it does not give name of anything, it simply says like how we normally write na, etc., any other. Similarly, what it has said, all other types of transactions which ultimately have the effect of transferring. Means what? Actually, the transaction is different, but what it results in? It results ultimately in transfer. So, in short, substance over form. What is the substance? Effectively, the asset is transferred. This is the substance. Simple. We will treat it as transfer. I'll give you example. What is the example of this? The example of this is, now again, a real life scenario. You are staying in a society. Normally, all over this buildings today are all under cooperative society, rather housing society. Now, as per the cooperative housing society laws, let us say in our society there are 200 flats. So the law, which is the housing society law, says that since we are a housing society, there may be a single building or there may be multiple buildings in this society. Let us say there are 200 flats. Now, please understand again, see, this is the housing society law. 200 flats, it says there are 200 shares. Now, interestingly, whoever wants to purchase flat in this society, they never purchase the flat. They purchase simply the share. So, one share represents one flat. Now, I want to purchase flat, but I don't purchase the flat. As per the law, I become a shareholder. Now, once I become a shareholder, that is, I purchase one share, the society says, okay, now this whole is my asset because this building belongs to me. Who am I? I'm the housing society. Since you are one of my shareholder, I'm allotting one flat to you. So because of purchase of this one share, I am given the right to occupy this one flat. This is what is the provision. Now comes the point. Now in future, whenever I'm selling this flat or I want to sell this flat, again, what is the law? Same law. It says that you cannot sell the flat. This is what the law says. Why? Because you're not the owner of the flat. What you want is you sell this share. So what I do is, on paper, this is what is the form. On paper, I'm selling the share. But in substance, what is happening? In substance, my flat is getting sold. So what does this clause 7 says? Any such types of transaction which in form on paper are showing something else. But in effect, it is what? It is doing transfer of immovable property. So again, through this residuary point, they want to cover all such transactions where on paper, you will say, okay, it is a sale of share. I have just simply sold one share. But what effectively in substance I have sold is an immovable property. So such transactions which on the face appear something else, but at the back it is sale of property, they are saying we will consider it as transfer of property only because in substance that is how it is. Right, students? See, now today you'll understand key why you find taxation laws so technical, so vast, in your words, so difficult, because they are covering variety of transactions, because tomorrow they do not want that anything should go untaxed. Why? Because they could not include it. So they try to cover everything. Now, since till date you do not know these other laws, or you do not have the practical knowledge of real life situations, you may find these very technical, but they are not. Once you know this this cooperative society law, or here, once you know this Transfer of Properties Act, you will very well understand our provisions because they have been taken from these various laws only. Now, Section 247 has firstly covered all these transactions as transfer. And now it says that though we have covered all these things in transfer, however, now I'm coming to the exception part. Out of this, some transactions I do not want to tax. Now, what I do not want to tax, I will say that it is not to be regarded as transfer. Means what? Now we are going to talk about some transactions where actually something is getting transferred, something is getting sold, something is given to someone, but I don't want to tax it. Now, how I will not tax it? When in actual reality, something has been transferred, but still I don't want to tax it. So my simple answer is I will put an exception. I will call that transaction as that this transaction will not be regarded as transfer. So I don't want to treat it as transfer. Simple, out, no taxability. Understood, students? Is this clear? So now what we are going to study is list of those transactions which are actually leading to transferring the asset to someone else. So now in all these situations, your asset is going to someone else, but the law says I will not treat it as transfer. In simple words, what the law want to say, I don't want to tax it, right? But again, as I said, the general rule made is what? The general rule is this, that if there is a capital asset and if you have transferred it, capital gain will apply. But I don't want to tax. I have some exceptions. As I said, every rule will have exceptions. Now, this rule that there should be an asset is transferred will lead to capital gain has some exception. What is the exception? In some transactions, I do not want to tax. So how will I not tax those transactions? By calling those transactions as out of the transfer category or calling them as not transfer transactions. So in those transactions, the law is saying don't treat them as transfer. Since the law itself is saying don't treat them as transfer, automatically what will happen? This condition is not satisfied. Since it is not satisfied, you will not tax it. So understand firstly the purpose of making this list of not transfer. The purpose is I do not want to tax them. Now, what are those transactions which the law has kept outside the transfer definition? So first is given in section 46, and let me tell you it is subsection 1 because there are two subsections. It's subsection and the first transaction is covered. Now, what is this transaction dealing with? Let me again explain the real life situation. So there is a company. The company has gone into liquidation. We understand this. So there is a company. The company goes under liquidation. Okay? We have all studied this. We have read this in company law, in accounts, everywhere. Now, what will happen when the company will go under liquidation? The company will pay off all its liabilities. How it will pay off its liabilities? by selling each and every asset, and whatever money it will get, it will pay to creditors, it will pay to loan, it will pay to bank, etc. And finally, after paying all outside liability, it will discharge the amount to the shareholders, because shareholders are also liability. They are also holding shares in the company. Now comes the point. Now just take a scenario. Company has paid off all outsiders. Now we are talking only about shareholders. Now finally, this company has to pay to the shareholders. Now what choice company has? Choice one. Let us say the company has its building, its land, its motor car, its furniture, its AC. All these things are now left with the company. So remaining all assets are sold off to pay off the outside liabilities. Now this few assets are left. What is the option? First, company will sell these assets outside, get the money, pay to the shareholders. Simple. If the company is selling the assets outside, it is a transfer. First, asset is there, yes. It is sold, yes. So it is a transfer. It is taxable, yes. As per our definition of transfer, it is a transfer, it is taxable. However, you all will know and understand one thing, that when the company is trying to sell these assets outside, since these are old assets, plus the company wants immediate money so that they can pay to the shareholders and close the account, definitely these assets may get sold at a very low price. Why? One, they are old, second hand. Second, the company is trying to dispose of fast so that the liquidation process completes. In such cases, there is a possibility that the company may sell it for a low amount, and if it's selling for low amount, the shareholders will get a low amount. Instead, sometimes what happens, the company calls a meeting of shareholders. Let us say there are 40, 50 shareholders. It says that, see, I have these assets left. These are your amounts which I have to pay. Let us do one thing. Instead of me selling the asset outside, which will fetch me very less amount and ultimately it will be your loss, let us do one thing. I will give away the assets to you all. I will give away my assets to you in discharge of your outstanding balance. This is one of the transfers. Which transfer? Relinquishment. I'm giving away my asset. So what I do, I make a list of all shareholders' outstanding amount. The shareholder who is having a very huge outstanding amount, I give them land. Another one, I give them building. Those who are having small amounts, somebody I give AC, somebody I give sofa. Those who have some slightly bigger amount, I give them the Mercedes car. So what I have done, I have distributed the assets to the shareholders when I was under liquidation. Now the law says, when a company is under liquidation, and at that time it has distributed, given away its assets to the shareholder, we will not treat this distribution as transfer. In other words, on this giving away of assets, the company will not have to pay capital gains. There will be no tax on this transaction. So assets of the company are given away to the shareholders when the company is under liquidation. Then this act of giving away, which is nothing but relinquishment, one of our transfers, will not be treated as transfer. And the moment you say we don't treat it as transfer, no capital gains. Correct, students? I hope this first situation, which is to be treated as not transfer, is clear. Now I come to the second situation. Rather, now remaining there are some 15, 16 situations. All are covered in section 47. So now first situation was covered in 46.1. Remaining are all covered in 47. Various clauses 1, 2, 2A, 3, 4, etc. Now we come to first clause, 47 clause 1. Same like the above situation. Now here the situation is of HUF. Now same like liquidation, here the HUF is under partition. Like how the company was under liquidation. Now for HUF, what is equivalent to liquidation? Partition. Again, what will happen on partition? HUF has to pay off all its members who are the co-partners. What HUF says that, okay, all these family members, I have to pay them. what I will do, I will distribute my assets to all of you all. So instead of selling these assets outside, somebody I'll give the building, somebody I'll give the refrigerator, somebody I'll give the motor car, somebody I'll give the jewelry, somebody I'll give the FD. Whatever assets I have, I distribute the assets. Who am I? I'm HUF. When I'm doing this at the time of partition, which may be total or partial, makes no difference. So this point you can say is similar to the company situation. Over there, it was liquidation of company. Company gave away the assets to its owners, that is shareholder. Here, HUF is under partition, same like liquidation. Here, HUF is giving away the assets to its owners, that is the members. So both transactions are similar. We don't want to tax them. Anyways, they are under liquidation. Let me not tax them if they are giving away the assets to their own members, their owners. This is what is the logic. Clear, students? First two cases of not transfer. Next case, which is in clause 3. You are an individual or HUF, and again you are relinquishing your asset. What is relinquishment? Giving away. How? By way of gift, by making a will in which you put somebody's name that, okay, after my death, this asset will be of this person, or by giving it permanently. Irrevocable means permanently, you are donating it to a trust. So whenever an individual or HUF donates or gifts its assets, gift, donate, or by creating a will, gives away the assets to anyone. Here, the person to whom you are giving need not only be your family member, anyone. So whenever you are giving away, how? By way of gift, will, or like a permanent donation to trust. We do not want to tax it because anyways you are giving it away free. I don't want to tax it. So whenever capital asset is given away by individual or HUF, but how? In one of these three ways: gift, will, or donation. No capital gains on that because we don't treat gift, will, donation as transfer. Now, next two scenarios. What is the scenario? There is a holding, there is a subsidiary. And most important, this is a 100% subsidiary. I hope you all understand. 100% subsidiary means all shares of the subsidiary are owned by the holding. Now, please understand this practically. If you are my 100% subsidiary, right, then you and me are same. See, in the eyes of law, we are two companies, so we are separate entity. You are a different person, I am a different person, agreed. But again, substance is what? If you are my 100% subsidiary, whatever you earn is ultimately coming to me only. So what we say na, jo tera hai, wo mera hai. Why? Because you are a 100% subsidiary. Now what does the law says? If this is the situation, then if any assets are sold by such holding company to subsidiary or vice versa, by such subsidiary to holding, any asset is sold. Now, obviously, this should trigger capital gain because both our conditions are satisfied. You have an asset, it is sold. Let us say the holding has sold some building to the subsidiary, or the subsidiary has sold some machinery to the holding. This fits in our capital gain requirement, but this is again an exception. We don't want to tax it. Why? See the substance. Even if I'm selling to my subsidiary, ultimately the subsidiary is me only because I'm the 100% owner. Even if the subsidiary is selling to me again, it is me only. So it is like me selling to myself. Only in the eyes of law, company law and general law, since we are two companies, we appear to be two different persons because that is what the company law says. But go by the substance. In substance, since we are one and the same, how can there be a profit between us? So not taxable. So holding is giving to its wholly owned subsidiary, or subsidiary is giving to its wholly owned holding. So next two clauses are holding to subsidiary, subsidiary to holding, where it is a 100% holding subsidiary relationship. Now coming to next few set of transactions. Now, what are these few set of transactions? Now, in these 4 transactions, as you can see the names, what is covered? Amalgamation, demerger. Now, what is covered in these 4 transactions? Let me explain. So, there is company A and there is company B. Company A gets merged in company B. Common example, this is what we call as amalgamation or merger. Now, what will happen when company A gets merged or amalgamated with company B? Again, in your books of accounts, you show that all assets are sold. So what company A does in the books of accounts, if you have done accounting of amalgamation merger, in the old company or the amalgamating company, we show the journal entry as if company A has sold everything to company B, which is correct also. That is how amalgamation happens. And company B will pay some consideration, which is called as purchase consideration. So whoever has studied amalgamation in accounts, you will understand what I'm saying. Now, here in income tax, there is a specific definition of amalgamation. So as this word is given, scheme of amalgamation, it is defined, where it says more than 75% of shareholders of the old company also become shareholders in the new company. So when such conditions are there, it means majorly all shareholders have shifted to the new company. So again, in essence, the shareholders majorly of the old company, they are also the shareholders of new company. So same, if as per Companies Act, there is another definition as per Income Tax Act, since when majority of the shareholders of both the companies are same, right? So in essence, what has happened? I am selling again the asset to myself. So that is why whenever there is amalgamation, now this situation may happen either at the time of amalgamation or at the time of demerger. In both cases, they say that I don't want to tax this transaction. Why? The logic is same. Old and new are same persons. In the eyes of law, they are two separate companies or two distinct persons. But in common parlance, in substance over form principle, seller and buyer are same. So how can there be two profits? Or how can there be income between them? So this logic applies that whenever there is a sale of asset by the old company to the new company in the scheme of amalgamation, we will not tax it. Similarly, whenever there is sale of capital asset by an old company to a new company in the scheme of demerger, we will not tax it. How we will not tax it? We have put these transactions in exception of transfer. So they will not be treated as transfer. The moment you don't call them as transfer, automatically capital gain will not apply. Now, interestingly, the effect of above amalgamation demerger happens on the shareholder. What is that effect? Now, I am the shareholder of the old company, which got amalgamated with the new company. Now, what happens, students, if you know, in amalgamation or even in demerger, this shareholder, they give away the shares of old company. And in exchange, they are given the shares of new company. This is how the old company shareholder become the shareholder of the new company. This was one of the conditions of amalgamation, that majority shareholders of old should become shareholders in the new. But how this happens? I am the shareholder of company A. I will give away my company A share, and in exchange, I am given company B share. Now, in my hands, what has happened? There is exchange of shares. Old shares are given, new is received. So there is exchange. Again, we have seen in the definition of transfer, even exchange is transfer and share is a capital asset. So effectively, I am satisfying the condition. But same point. I have done this exchange simply to change my position as shareholder from A to B. Right? So effectively, I have not earned anything because simply what I have done, whatever was my position in A, I have become the same position in B. Now, in this particular case, they say that whenever this exchange happens, either at the time of, so here first they have given demerger or at the time of amalgamation. In both cases, even though there is exchange, I don't want to tax it. Are you getting this? So amalgamation, demerger first in the hands of company when old company is selling the assets to new company is not taxed. And amalgamation, demerger in the hands of shareholder where the old company shareholder gives away its old shares and in exchange get the new shares. I don't want to tax it. So the entire amalgamation demerger scenario in the hands of company and shareholder both is outside capital gains. See, if you understand practically, it becomes easy to remember also. Then, if you remember recently, the government has brought some amendment, especially for foreign investors, because we want more foreign investors to come and invest in Indian markets, right? Because if you have seen, because of Iran war and other global reasons, our stock market is going down. But the government announced some measures in the last week, and hence you will find some upward trend in Indian market. Now, this government keeps on doing. Now, similar such thing has already been done in the past. I'm not talking about the recent amendment because that is not applicable to you. If a non-resident has purchased government security means India security, how they may have purchased it anywhere, but today what they are doing is they are selling this security outside India. How outside? One non-resident is selling to another non-resident. So simply where one non-resident is selling to another non-resident, obviously it will happen outside. But what is the asset? The asset is Government of India securities. We want to make this tax free. Why? So that today the investors will come to my market, they will purchase these securities from government, and they know that in future, whenever they sell it, they will not have to pay tax. So condition put is one non-resident selling the government security to another non-resident. We don't want to tax it. Next. Now, if you remember, some time back, Honorable Prime Minister had made an appeal that we should stop buying gold for some time to save our foreign exchange reserves and also to help Indian economy not get affected by huge purchase and imports from outside. In past also, government has done something so that people, instead of buying physical gold, see, in India we have a special connection with gold. It is economical also, that is relating to economics and also relating to emotions. Now, what is the economical connection? We always have a belief that gold will always increase. So it is the best asset to buy, so that today you buy, it is also an asset with you. And in future, if you have to sell it, you'll always get a higher price. Now, long back in 2015, the government had brought a concept that instead of buying physical gold, you buy our bonds. Now, since these bonds are issued by the government of India, they are called as sovereign. Sovereign means something relating to the government. So they had issued these bonds and said that you purchase these bonds. So you want investment, huh? You buy these bonds. The best part is you will not buy physical gold, so we don't have to pay to outsiders because majority of gold is imported from outside. So you buy our bonds and we will link these bonds to the gold price. So today you are buying when the gold price is 50,000. Tomorrow, when the redemption of these bonds will come, the price is 1,50,000. We will return you back 1,50,000. So the government linked the bonds with gold. That is why they are called as gold bonds. Now, whenever the government will redeem these bonds, whatever profit you will get, there will be no tax. So effectively, you have sold back these bonds. Bonds are asset, you are returning it back. So it is a transfer. But since the government wanted people to come and buy these bonds to reduce the dependence on physical gold, they had to give this lalach. What is the lalach? That whenever the individual will be redeeming these bonds, that is returning back the bonds and taking money from RBI, whatever will be the profit, that will be not taxed. Similarly, again, the government, like sovereign gold bonds, had brought another concept called as electronic gold receipt. So instead of taking physical gold, take it in the form of electronic receipt. What is electronic receipt? So like how today you are not having physical shares, you are having the demat shares. That is the shares in the demat form, non-physical form. Similarly, gold, keep it in non-physical form. Now, how you can do it? You already have gold, physical gold. The government said, you give us the physical gold and we will give you the receipt. So you have converted your gold into the receipt. Now, what will happen? Today you convert it. In future, whenever you want back the gold, you give us back our electronic gold receipt, we will return you back the gold. Again, this was one of the measures to save physical purchase of gold from outside. Now, you are already having a gold. What you have done? Exchange. How? You gave the physical gold to government and they gave you the gold receipt, not transfer. In future, again, when you exchange it back, you give back the gold receipt and take the physical gold. It is not transfer. So conversion on both sides, gold to receipt or receipt to gold. Both are exchange, not taxed, not treated as transfer. Dakshibada, what is a bond? So bond is like a share, debenture. You have another paper called as a bond. So instead of buying gold, you buy that bond, but that value of the bond is linked with the value of gold. That is why it is called as gold bond. Isha Beda, don't worry. Very specific condition. When I'll revise this in the next class, I'll take. See, I cannot, if you see my approach, I do not teach everything in the first class for two reasons. Why? If I try to teach everything in the first class for you, it will be very boring. It will be very heavy to digest. Second, when I repeat it in the next class, automatically there is a revision. So whatever I explain first gets revised. And now in the second class, when I give you some additional technical point in that, it is easy. So I understood what is your question, but I've purposefully not taken very minute conditions of each of these points. That is where is your homework. So you first read the format. After the format, you have the capital asset definition. You may even read that today because in the next class, I'll be taking the definition. And immediately after the capital asset, you have these definition of what is transfer, what is not transfer. So you have to read your module till this point and mark each of these specific conditions, whatever you are not able to understand. But I'm purposefully keeping it outside. And then the next transaction, which is not transfer, is if you are selling some specific assets to the government itself. Now, what are these specific assets? Let me again tell you the real practical situation of this. Now, we are having many things which are of national importance. What is this? Let us say you have some old painting of Rabindranath Tagore, the painting, actual painting of Rabindranath Tagore. Now, for us, Rabindranath Tagore is a big national figure, and anything belonging to him, anything belonging to Gandhiji, anything belonging to Subhash Chandraji Bose, any one of these is a national treasure for us. Now, you would be knowing that many times people sell these things outside India. That is why many of our things are today in foreign museums or with some foreign rich people. Now, the government wants that our national treasures should be in our own country. Now, what could be these national treasures? These could be some paintings. These could be some archaeological or scientific collections. These could be some very old books. So you have the original copy of Constitution. You have the original Manusmriti book, etc. So anything, manuscript, drawing, painting, photograph, print, anything which the government considers as of national importance. Now, the government does not want these things to go out of India. So what they are saying, you sell these things to us, to government, a university, national museum, national art gallery, etc. So all these are government bodies. You sell it to government or any of the government bodies. Now you are selling it, so it is transfer, but I don't want to tax them. So that out of this lalach, you will not sell it outside, you will sell it to us. So the treasure will remain in India. All these are our treasures. And then two more things, simple ones. Now in accounts, you have seen that you had originally purchased bonds or debentures. Later on, you give back the bonds and you get the shares. So there is a exchange. Bonds converted into shares. Or second type of exchange is preference shares converted into equity shares. All these are exchange where you give away the old bond or debenture and you get equity shares. You give away the old preference share and you get the equity share. Not transfer, not taxable. So students, these are some of the scenarios which even though leading to transfer, something is actually going out, something you are giving away, but the government does not want to tax it, so they are not treating it as transfer. I hope I'm clear with this. So your homework is to read up to this page. Now, in that, something I have not yet explained, like capital asset and all. Still, but that you'll understand. Some part of it, what you'll not understand. Anyways, we are going to discuss everything. I'm going to revise this and plus the new part. So, students, I hope today's class you understood everything. First, keep this part in mind so that you get an overall picture. You can just take a screenshot of this because this sheet or page I'll be sharing at the end, because now I'll be writing many important things over here. So you can just take a screenshot. So you'll always have this complete picture of the chapter in front of your eyes, so that whenever you want to understand anything, first come to this page, read whatever is given, and then link it to whatever independent things we are doing. Today we studied this. First fill in the blanks we completed. Right? Okay, students, done with all. Should we conclude? Yes? Understood? Perfect. So let me tell you, students, if you ask any of your seniors, they always fear two topics the most in income tax, PGBP and CG. And I tell you, if you study it systematically, if you follow my instructions, these two will be your biggest strengths. And understand this, if they become your biggest strengths, you will get the maximum marks in this paper. Plus, at final level, again, you will get the maximum marks because majority of paper is on PGBP and also on CG. And thirdly, in your profession tomorrow, if you start your own practice, these are the topics. Excellent, Enam. So if you're writing along with me, that is even better. Excellent. Make your own notes. Thank you, students. Thank you very much. Good day. Take care. Bye-bye. Please read. Yeah, from my side, it is over. Daksha, if you want to connect to me, you can take my details from the viewers, right? Thank you all. Good day. Bye-bye. Thank you, Ashok.